Okay, part one, selling puts. Okay, I'm going to pull up a screenshot of the definition of selling a put. So if you are buying a put, that gives you the purchaser the right to sell an asset, the underlying, that would be the stock. And if we're talking about AMC, that means if you bought a put, it would allow you to sell AMC at a specified price, the strike price. Well, apes and holders are not selling, so there shouldn't be anyone buying any puts. But I assume some day traders and some traders are doing that. And certainly market makers and institutions and those people are also doing it to hedge their trades. So, but as an option seller, especially on AMC, get this definition. Strategy an investor may use to generate income or buy stocks at a reduced price. So when people are talking about how negative it is to trade options, we can't be talking about selling puts or writing a put, because that's where you agree to buy a stock at a reduced price. So who wouldn't want to do that with AMC? Would you not want to buy that at a reduced price? So understanding the definitions of options trading and what kind of options trading may be harmful or good or bad or ugly is the point. The most important thing to understand is that when you sell an option contract is 100 shares of stock. So when we talk about a put option, that's 100 shares of the underlying stock. Okay, I want to briefly just explain how the option will work by showing an options chain. I want everybody to understand who's watching this that this is part one. It's meant to be short, quick, and get the basic concept. And then I will go into detail on parts 2, 3, and 4, or whatever, however that works. Okay, so I'm going to pull up a options chain. Going to use I'm in Yahoo Live right now, so this is from yesterday or from Friday. This is the options chain. We closed at 40.74, and I'm just going to go through this very quickly. Like I said, I can go into more detail when I go into exactly how to pick a price based on which strategy you're using. So anyway, right now, and I have this set on straddle. So here's the calls and here's the puts. So when you want to sell a put and you pick a strike price, let's say you had a $40 strike price. There it is in the middle. Okay. And then you go over here and this is the expiration. So let's go backwards. We go back to the expiration of next Friday, October 22nd. Okay. And there's the 40 strike. That means that you can sell a put for $1.48 per share, and the contract is always 100 shares. So that means you can sell this contract for $148 in your pocket. When you sell the contract, the money is credited to your account immediately. Normally you have to sell on a bid in order to get immediate execution. If you sell in between the bid and the ask, you may get an execution. If you sell on the ask, you may have to be patient until there's a run-up, just like when you buy and sell stock. Okay, so if you sold on the bid, let's say this is the bid, for $1.48, you get the premium in your account immediately. So you need to understand that. It's not something you have to wait for October 22nd or whatever. Okay, so when you sell it for 40, the money's in your pocket immediately. But that also means that if the price goes down to 40, at any time, the person you sold the options to or the market maker can execute or exercise that option and take and sell you the stock at $40. Okay, at any time. But let me make sure you understand also as a 20-year options trader that rarely, if ever, has never happened to me. They don't just exercise. That people trade options right up to the last minute on Friday, and then either they're assigned or they've already bought their way back out of the option and the option is simply closed. Okay, so there's generally no stock changing hands at the point that the option is closed. All right. So that's basically how it works. So let's say we're going to pick the $40 strike price. So I want to show how you put the orders in. So I'm going to show you on E-Trade. I will show how the options chain looks in a more sophisticated trading platform, and I use E-Trade. It's really an easy platform for me, and I'm sure there's others that are better, but it doesn't really make any difference to me for my style of trading. Okay, so here you get the same thing, a bid and ask. This one is November 5th expiration, so you could sell one at 37, let's say. When I took this screenshot, the price was somewhere around 37.19, so you could have sold a 37 at 390. Okay, so there's quite a bit of spread there, but the last price was 390, and there's the deltas that you hear about, the implied volatility, the theta, volume and open interest, things like that, gamma, vega, and intrinsic value. Those details I would go into in a more detailed video on how all this kind of stuff works. But basically I wanted to show how to place the order, because so many people are very nervous about how to place the order, and you should be. You don't want to make a mistake when you place an order for an option. So when you're selling an option, this is what the order entry system looks like on E-Trade, and you can do it. You can do it also with this platform by clicking on the bid or the ask, but I don't do that. So and not for the purpose of this video anyway. So here's where you are, and this is what the initial screen looks like up. So you have a symbol of AMC, last price 37.19. It's asking you if you want to select a strategy, and it's going to say custom here. So if you have this, or add a stock leg, option leg, these are all the complex things that you want to do, that you could do. For example, if you hit custom and you wanted to select strategy, here's all of these different strategies and acronyms that I don't even know what they all mean, because I'm a very simple trader. Been doing this for 20 years, making a huge amount of money, and I really do everything very simple. So I'm probably a good guy to learn from if you want to keep things simple. Okay, then you have this screen where you pick the action. So when you click on the action, you get this window. Buy open, sell open, buy close, sell close. So those four choices can get you into trouble if you don't know what you're doing. So if you want to sell an option, you must look at sell. And that gets to be a little confusing for beginners, because they think they must first buy something in order to sell it. Well, this selling options is basically the same thing as shorting. So when you short something, if you short a stock, that means you're selling it before you own it, and you're hoping to buy it back cheaper. In the sense of selling an option, you're selling the option to buy the stock cheaper. Okay, that's a put option. So when you sell a put option, you're selling the put option so that you can buy it back, buy the stock cheaper. So you want to make sure you enter the order correctly. So when you open an options put sell, you must say sell open. Okay? And then you get a screen that's going to, once you hit the sell open, you can put the expiration date in, the strike price you want to sell it for. It'll give you the bid price, the ask price. You can click actually on the bid, and then or wherever you want, and enter in the price as a limit order. Do not sell options with market orders. You put the price in you want, exactly what you want for the trade, and do not use market orders. Okay, then you can check to see if you made any mistake. Here my commission would be 50 cents I would have to pay, so my proceeds are $344.48. Okay, so that's your basic screens. You got the little small options chain over to the side. Before you actually commit yourself, you can do a preview order. Okay. Okay, if you open the preview order, and I didn't make a screenshot of this, but if you open the preview order, it's simply going to say a sell open 1 November 5th, strikes 36 at $303.45. Okay, and then you'll have a little screen that says place order. So it's that simple. So you want to make sure that you use the right terms. Sell open, sell a put, and make sure you're getting a proceed and not paying out something. All right, so because this money is going to be, if you get an execution, this money is going to be immediately deposited into your account and you can spend it that very day. Okay, so then when you want to close out an option order, and I'm going to go into this in detail in another video, but when you want to close out an options order, people are often confused. They think, oh, the option's going to get exercised, or it'll expire, it'll do all these things. There's many different things that can happen, but primarily you simply are going to go up till the expiration date, and then you have the choice to close the order out at any time between the time you sell the option and the time that you buy it back. Okay, so when you want to close out an option, you want to use these terms. Here's your strategy. It's a put. You want to buy to close the put. All right, again, the expiration date, the strike price, the put, and there's the bid ask. Now, if you bought to close the very same options that I just sold, you would have to pay estimated total cost, $345. Then you do the preview order, and then you do the place order. Okay, so the idea is, well, let's talk about 3 things that can happen. What 3 things can happen if you do an options trade? So I'm going to open back up the options chain. We'll go back to the $40 strike price. So I did all those execution plans there. I traded at $40 strike price. I sold the option for $148. Now there's 3 things that can happen. One, we go up to the next Friday, October 22nd, and the price closes at 42. It went up. All right, so 3 things can happen. On Friday, you can just wait and do nothing. You keep the $148 regardless of what happens. No matter what happens, this money is yours. If the price goes up to 42, and you do nothing on Friday at market close, that stock will expire, that option will expire worthless. And when it expires worthless, then at some point on Saturday or Monday, then the option will show that it's closed, right? So the other thing that can happen is that you can choose somewhere between the time you sell it. Let's say you sell this on Monday for $148, and then if the stock goes up, the price of this option will go down. So as the price goes higher and higher, you got 2 things that happen to it when you're a seller. You get what they call theta decay, and you get the time and the fact that the option pricing is based on how close it is to in the money. So the higher the price goes, this number is just going to continue to go down. So if the price goes, say, to 50, this option will start trading for about 5 cents, which means you can buy it back. So what I've been saying in my Twitter account is that I buy my put options back on days. Okay, so as soon as I'm in the money and this price goes down to 70, 60, 50 cents, and it's a day, normally I buy it back. And why do I buy it back when I could just let it go to 0? Well, maybe it's not going to go to 0. Maybe in Wednesday it's going to start falling and go right back up to a 148 or closer to 148, or worst case it goes to 39, and then it'll be more than 148. So you want to close out the option as soon as possible. So that, fundamentally, only reason I'm explaining that at this point is that you want to use this buy to close when you have the chance to close out the option at a profit. So That's the strategy for buy to close. Okay, now there's three strategies that you can use. One, you can find a price where you think it'll never get executed. So you can go down here and sell the option, say for $10, right? You can sell here, or if you want to go further out, you can go to, some people trade at 4 weeks out, some people trade at 8 weeks out, and I'll go into detail on how to pick the number of weeks out based on what can happen when I do the next video on risk strategy and rolling your option. So now here you could do, say, a 30 for $74. So that's not too bad. That's about 100% yield on an annual basis, maybe a little bit more than that. So that's if you were able to close this out, let's say, in 1 week. So that's called way out of the money, and that means that you don't want the stock, period. But let's say you're an AMC guy. You want to buy the stock at 40. You see it's trading right now, right in between 40 and 41, and you want to buy it at 40. You don't know about paying 41 because you think maybe it's going down next week. Well, look what you can do. You could sell the 40. Instead of paying 40 for the stock, you could sell the 40 put option. You get $397 for that. And if the price goes down to 38, you're still making a profit because it has to actually go all the way almost to 36 before you at break even. So that's the point. You want to sell, if you want to buy stock, sell the option. If you feel like it's going to go up a little bit, but you don't think it's going to go up too much, you could sell an in-the-money put. That's the other option you have. You could sell an in-the-money 41 for $468, and that's expiring in 4 weeks. So let's go back to expiring in 1 week, because if you're wanting to actually buy stock, you're going to need to be pretty close to the time frame. So you could actually wait till Thursday. Let's say if you did this on a Thursday and the stock's going and the option's going to expire on Friday, you can sell this for $194 in the money. Your break even is 39 or just above 39. And then when the option goes through expiration on Friday, it'll be in the money, and then the stock, the money is taking out of your account, $4,100, but you got $194 in advance. Okay, so you still got it at a cheaper price, even though you were wanting to. You would have paid 41. So that's trying to understand the whole idea behind selling puts, is that you get the premium and the price if you buy it at the price you were going to buy it anyway. So you're already ahead by this premium money. So that's trading right in the money. The other thing you can do, and I'm going to explain this in the next video, is you could also sell at 40. And let's say the price goes down to 40, but you think it's going to go down to 36. You can do what they call rolling. You can go out 1 week, right? If it goes to 40, you go out 1 week. And look, there you can sell that for more. So you simply buy the 40 back from the October 22nd, and you sell the 40 at the next week. All right, or you can even go now, drop it to 39, sell it. You're still in money. You still made 50 cents. And then, so this is a more complex understanding of rolling. In order to do that, you need needs to be a dedicated video, because it'll make this one too long. And this one's already longer than I want it to be. So fundamentally, you have three strategies: way out of the money, right in the money, or very close to in the money. And what you do with those strategies and how you develop them requires some training and experience. But selling a put is, from the basic concept of selling a put, is very simple. You simply got to find the strike price you want. Make sure you know how to make those order entries, because this part is very critical. And so I'm going to kind of repeat this summary so that you get the basics. So first you have to find the strike price. You find the strike price by doing technical analysis and choose where you would normally buy the stock, and decide whether you want to buy it or you want to just make money on the options premium. So those are basically your two choices. So, so that's your first big step, is getting comfortable with how to place the order. When you sell a put, it's sell to open, select a strategy, a put. You want to sell open, a put, and then you have to choose your price that you want, somewhere between the bid and the ask. Okay, so that is not rocket science. The actual order placement is very easy, and you have to understand that first you need options level 2 in order to do this, and secondly you need the cash in the bank to cover that put. So you cannot just sell it for $325. This is not what the concept. A cash secured put means that you have to have the price of the strike price. That's 36 times 100, $3,600 in cash. The cash is not taken away from you. It's simply put in a bond or a hold area until the option expires. Okay, so once the option expires, the cash is released back to you. And at all times, from the moment you sell the put option, the price of the option, the premium they call it, is money in your pocket, already credited to your account. So if you sold this option, if you had exactly, let's say, $3,700 in your account, and you sold this 36 put, you would have then the $425 in your account, and plus the 3,600 would be on hold. Okay, so just it's a little tricky there, but these are all not such important points at this time. So you want to get comfortable first with selling the open, sell open, put, and pick your price. Okay, so that's the technical analysis. Now, for the final point I want to make, because I want to give the whole idea of doing this video is to throw out a concept. And this concept's a bit tricky, but and making sure that you understand in all of this and all of my videos, there's no financial advice. There's only for entertainment and education purposes. But let's look at this concept. Let's go back to the options chain. So here you are at the options chain. And this is this week, so we're going to pretend like this is we're coming up on October, let's go back 1 week, coming up on October 22nd, okay? And here was what all the apes are saying. Some of the apes are saying. You have people that are pro-options traders, and you have people who are anti-options traders. And some people are griping and moaning about options traders ruining everything for the community. And so I'm going to throw out a concept, and this is just for fun and theory. But let's say, since I'm an experienced option seller, let's say I'm a big whale, and I have billions of dollars in my account. Okay, so what would happen? Here, let's go look at the open interest on 40. There's 10,494 contracts open interest. Sorry, that's 2,355 currently open. The volume was 10,000. That means those have already traded. So let's say the open interest is 2,355. And if you multiply that times 100, you're going to get, 23 million or whatever, or 2,355,000, something like that. I'm not doing any good math off the top of my head. But let's say I'm a billionaire and I want to sell 1 million put contracts at 40. So what would happen? Think about that. What would happen if I sold for this coming Friday 1 million put contracts at 40? Well, would the price stay at 148? No, because there just wouldn't be that many buyers, right? Now, the market makers, he theoretically has to fill your order. So what would happen? Probably this price would go to 1 penny, I would think. I mean, this is all theoretical. So, I, in essence, as a retail trader, me personally, and I'm only talking about me here, if I sold 1 million contracts, and do you ever see 1 million contracts? No, never. It's never been done before. So this is a paradigm shift. If I sold 1 million contracts at 40, it would freeze the price at 40, because what would happen? A hedge fund, he wouldn't want to drive the price down to 40 because he would end up having to sell 1 million times 100 would be 100 million shares he would have to sell to me as a retail buyer. Would they want to do that? No. So let's say this week I sell the 40, 1 million contracts. I'm a millionaire. What's going to happen? Market maker, hedge fund, institution, he's going to keep that price above 40. So let's say next week I sell, and so now 40 goes by, it didn't go down to 40, so all those options expire worthless. I keep whatever premium I could get for 1 million shares, might be only a penny each or whatever, but I get to keep all that money. Now it goes, now next week I sell 1 million contracts at 41. What's going to happen with that? Same concept. Never been done. 726 open interest right now. Change that number to 1 million because DiverSK bought 1 million, sold 1 million put contracts at 41. What choice does the market maker have there? What choice would the hedge fund there? Is he going to drive the price down to 41 so he can sell me 100 million shares at 41? Now, that's going to require a lot of money from my part. I don't think I have that much money. But, you know, Elon Musk has that much money, Jeff Bezos, or somebody has, you know, people have this kind of money to throw at the market. So I'm just saying that's a theory, and that's for entertainment purposes because I know nobody's thinking about that. So just want to throw out some food for thought. And at any rate, that's the end of this video. Video 2, part 2 is going to be on risk and roll. How do we exactly pick the price based on this, which strategy, and in the event the stock goes against you, which is covering your risk, how do you handle? There are different ways that you can actually take away your risk almost altogether. And that's the beauty about selling options. The ability to roll your option to a later date. This is a risk strategy that can't be done with stocks and other platforms and things like this. And so with this kind of risk strategy, I consider selling options one of the safest things that you can do. Thank you.